Hello and thanks for joining us at interest.co.nz. I'm Jenée Tibshraeny and today I'm joined remotely by the Kiwibank CEO, Steve Jurkovich. Thanks for your time, Steve.
No problem, it's great to be here. Kind of.
Yeah, kind of. Hey, look, it's been a whirlwind few weeks, and the government and the Reserve Bank have announced a range of initiatives aimed at doing a few things, but largely to try to keep banks lending and keep that cash flow going. I just today like to run through a few of these things. To begin with, we'll talk about the mortgage repayment deferral. So banks have agreed to defer mortgage repayments by 6 months. So it's very much a temporary fix. What has the uptake been like at Kiwibank for this?
Well, yesterday was our biggest day. So we got about 1,000 calls yesterday. We've had about 7,000 in total. So, if you think about our market share and you extrapolate that across the market, there's a lot of phone calls happening.
Okay, how many of these application deferrals have you approved?
Good question, actually. I know there's 4,000 requests. I'd have the numbers later on. But for us, we're sort of rattling through them as fast as we can. A very high percentage of them being approved, though, would be the short answer. There's a definite flavour, speaking to our Chief Customer Officer and all of the teams in the contact centre, that I'd like to know what I can do rather than that I need to do it right now. For people that are earning and, have good security, so I'd say, number of essential workers, people working in police and hospitals and things like that, their serviceability hasn't changed. And so those aren't the sort of people that are ringing, because they do recognise that the deferral builds your interest costs. And with interest rates so low, there's still a whole lot of people that are making more than their minimum payments to pay down debt.
That's a good point, actually, that interest rates have come down so much. Steve, look, I mean, in recent years, say last 8 years or so, people have been borrowing up a storm to buy houses, and as we all know, house prices have gone crazy. How worried are you about how leveraged we are as households? I mean, the debt that we have and that in mortgages is just huge. How concerning is that?
Look, I think it's a very fair point that, we have had a very strong and benign economy for a long time. So first point is that puts you in a pretty strong position. And, I think all the commentators are all quite rightly pointing out that, all the money that the government is borrowing or that people are borrowing individually one day will have to be paid back. So there is no free money in the world. So I think that's a good point. Secondly, the property market has been strong, but it has gone through a cooling period in, the last 2 or 3 years in some areas. So look, the high LVR loans certainly are more vulnerable, I sense, if you were to go through a prolonged downturn. But serviceability is really the key issue. And so people earning, the LVR and the daily price of your property is probably not that relevant. If you've got somewhere to live and that's the home that you want to be in, then you'll value it and you're not trying to sell it. So actually the price of it's not so important. In a forced sale situation here, there's definitely some consequences, but overall, I'd say, not that worried at the moment, but certainly a great question about, how long does this go on for and how do we come out of it? I'm not so sure about, that we've gone crazy on the debt. I think most people have been, they've got a good idea about what they can afford. The LVR speed limits and those sorts of things acted as a bit of a break on things, as you well know. What I would say, however, though, is, if you'd been buying property on the idea that capital growth would come your way, you've got to wonder about that for the next few years. And I think that does emphasise the point that actually debt reduction and serviceability and personal financial management is probably going to come to the fore much more than it did previously, because a rising property price certainly helped a few people out. And if there's not rising property, then I think we all need to sort of think about actually, we're going to borrow to buy those discretionary items, or are we going to try and repay some debt? So look, I don't know if this is a new age of sort of thinking about those things in a different way, but you'd have to wonder about it.
Yeah, for sure. And hey, look, just talking about investment returns, the Reserve Bank this morning made an announcement, said that it's barring banks from paying dividends until there's a sufficient economic recovery. So it didn't put a deadline on that. It just said sort of until things improve. Do you have a clearer sense of when that restriction might be lifted by the Reserve Bank?
Great question. Short answer, no, but sensible decision, because if we are going to have Crown support for liquidity and for supporting customers, then it makes sense that there would be restrictions on where that money can be paid to. And I think, New Zealand taxpayers would rightly expect that if they're going to support, about a year's worth of credit growth. So if you think about the market grows at about 5%, there's about $120 billion worth of business borrowing, 6.25 billion equals sort of 5%. So it's a year's worth of credit growth. And the government and the Crown is taking 80% of that risk, then it's probably fair that they don't want to see that money channeled elsewhere. I think the certainty about being able to pay the coupons on the AT1 and instruments and stuff is a really important point, because if you can't pay those, then investors in the future start to wonder about what's the actual risk profile I'm taking on here. So I think that's a really sensible step forward. I think the dividends is understandable, and look, I think all the shareholders are saying these are extraordinary times and we'll have to adjust our response.
Steve, the public might be thinking, look, we are underwriting some of these loans. So we'll talk about this soon, but just for people listening, this is the business loans. The taxpayer is underwriting 80% of certain business loans for certain eligible businesses, which means that if someone defaults on that loan, a business defaults, 80% of that loss falls on taxpayers, 20% on banks. So people might be thinking, hey, taxpayers are stumping up. Are bank CEOs and directors going to take some pay cuts as well?
Look, I don't think any industry is going to be immune from that conversation. That is a question for boards and REM committees, ultimately, so not something that I decide, but certainly open-minded. When you look around the industry and see people facing into those headwinds, I think that's a really realistic request. I think also, just to emphasise your point, I think, just to be clear for viewers, is actually the risk that they take in terms of the government will be after all of the normal procedures about trying to realise the money back. So this is a last loss situation. So the banks will take all their usual procedures to try and realise security, and then if there's a loss, the government will step in. And actually, if you look at the bad debts that's been around for the last 5 years, actually they've been really, really low, incredibly low. So actually what we're probably seeing over the next few years is a bit of a return to the normal part of the cycle, where banks have had to absorb those costs and work that through. Now, there's nothing normal about the situation, don't get me wrong, but it is not abnormal that banks would have to swallow more on the losses during the cycle. And I think that's what we're facing into. I think we're all preconditioned, right, to bad debts being down below 1% and well low, north of 1% if you're a non-agri lender. So that is a big, big change for shareholders to think about.
Okay, and another thing on that is that so the idea behind the scheme, from the government's perspective, is wants to keep banks lending. So if it takes on some of the risk, they're thinking that's banks might be more liberal with their lending. Will Kiwibank be a bit more liberal with its lending, given it's taking on a bit less risk? So this is just with those business loans that meet this government criteria.
Yeah, I mean, they have to be viable businesses, and there is a lot in that word. We've been speaking about that for a few days, but the viable business point is a great one, which is, yes, I think the short answer to your question is yes, we will be more liberal, because what's normal in this circumstance? If I know where your offices are, you've got a thriving cafe culture that's busy 5-7 days a week, and it's super quiet now. Now, does that mean that those businesses that were fantastic hospitality businesses aren't viable in the future just because there's no one there? I don't know. I don't think so. I think people will return to those sorts of spots. Likewise, will people still want to go to Queenstown in the future? Yes, I think so, but it might be more domestic. So, what's viable? I think we're going to have to be much more open-minded about that, and we are going to have to look, more broadly and assess things and say, what, actually, let's back the people and let's back that. Human needs don't really change.
To jump onto something else now, the Reserve Bank has taken a number of measures, once again, to try to support liquidity. And it's kind of confusing to explain, but they're basically offering banks different loans with different terms, so that banks can then, keep lending to their customers. Has Kiwibank taken up some of these offers? So I'm thinking of that TAF particularly, and some people know what I'm talking about, but
sure.
Have you taken that up?
We have participated minor in some of the buyback stuff, which is just business as usual for us. So short answer, no, but longer answer, yeah, we probably will in the future. I mean, as you sort of touch on, markets, like any market that you participate in, needs a buyer and a seller. And actually, at the moment, there hasn't been many buyers for the type of debt that banks need to keep things running. So the Reserve Bank and Treasury are stepping in that. So actually, that's what's called making a market, as we both understand. But that's the role they're playing, is stepping in and saying, okay, on the buy side, you've got someone who's a buyer, and I'm going to buy across different terms. All of those things are great for the funding profile. Now, banks have spent, decades organising themselves so that if the markets dislocate or stop, then we've got enough money in the tin to keep trading. So actually, at the moment, there's probably no issue in liquidity. And actually, what you're seeing is a whole lot of people moving to term deposits and savings with banks because they see the safety and security of a bank deposit versus some of the other market alternatives. Rightly or wrongly, not sort of judging that. Just that's what we're seeing. So actually, that liquidity comes into the bank and means that you don't have to go into the wholesale markets because retail customers are giving you their deposits and trusting you with that. So sort of a little bit tricky, but absolutely, yes, we will. We think it's the right idea, but just don't need to yet. But I think the sooner you start...
When do you think?
Oh, look, I mean, in a normal course of events, we plan for not going into wholesale markets for, 4 or 5 months. So actually, certainly through the rest of our financial year and well into the next year. So we're talking, July and August. We know that we're in that position that we wouldn't need to. That doesn't mean that we wouldn't, because obviously it could be attractive, and we don't want to wait for the last minute because there's no guarantee that things get better before they get worse. So, it's a good option. I think most banks will be thinking about it at the moment, but wouldn't expect too much on the buy side at the moment.
Okay. And just to end off with a bit of a philosophical question, things have been moving quite quickly. The various interventions that the Reserve Bank is making in the market to try to support liquidity and keep interest rates low. There's been a lot's been happening in that space. Also, the interventions the government's making, and just the mere fact that the government is getting banks to decide basically which businesses will stay in business and which won't. It's underwriting these loans, but it's saying, banks, you decide who you're going to lend to. It seems like our whole sort of system is changing quite quickly. What do you make of this?
A couple of days ago, if you'd asked me, I probably would have said, it's a little bit like post-GFC when markets were very tight and things weren't working. But no, you didn't see anything like this situation. So I think, it is unprecedented. Look, I think the short answer for banks and supporting customers is there is no government agency that's got the scale that could handle dealing with 700, 800,000 business customers. I mean, banks are looking after those customers one way or another at the moment. My very strong view right from the early discussions was banks are best placed to try and make those decisions because they've got scale and they've got systems that can handle it. Now, it's going to take weeks sometimes to make these decisions, so I know that'll be frustrating for customers, but that would be a very, very long queue at a government department if you lined up 800,000 people wanting to talk to you about that. We're in the business of managing risk, and we should, that's what we get paid for, and that's what we earn our earnings from. So we have to live up to it. And, I think, we're well placed to do it. I think the actions from the government and Treasury and others to get things going and make bold moves is great, but I think it's just the start. I think we're going to see many more moves over the coming weeks and months around trying to keep things going. And as many commentators have touched on, yourselves included, coming out of it might be even more of a wicked problem than going into it in terms of a lockdown. So there's a lot of work to do. And I just encourage businesses, we're seeing really good businesses talk about the immediate needs they've got now, like what's at the end of their nose, but they're also, planning for post-COVID world. What are the opportunities? What size business will I have? How will I need to operate? So, if you can get a moment's breathing space for your business customers, I'd encourage them to try and think about, okay, what does medium term look like? And someone asked me that today, and medium term for me at the moment is like 3 months, 4 months.
All the time scales that we've used have just shortened immensely.
They sure have.
Anyway, Steve, we'll leave it there. But thank you so much for your time. I appreciate it, and I hope people watching from home have taken something good from the interview too. Cheers.
Great. Stay safe.